Hello, fellow investors, and welcome to another episode of Ritter on Real Estate, where we teach you how to passively invest like a pro. Very special guest today. His name's Jonathan Greene. Jonathan is a thought leader in the real estate investing space. He's the host of the podcast Zen and the Art of Real Estate, which I was previously a guest on, and we had a great time. So you guys will check that out. We'll link it below. And it's one of the fastest growing real estate podcasts in the world. So I'm super privileged to be there. He's a lifelong real estate investor. He's an on-market team leader and a luxury agent. He's a certified life coach, a real estate coach, and he hosts an in-person meetup as well. So Jonathan is just in real estate in all different ways, shapes, and forms. He's been investing for over 30 years, just a wealth of experience in a lot of different strategies. And so really excited to have him on today and excited to dig in. So thanks for being here, Jonathan.
Thanks so much, Kent. Glad to be on the other side of the mic. And yeah, you experience just means old. I'm getting old, but I've learned a lot over the time. So yeah, I'm excited to talk to you on this side as well.
Absolutely. Absolutely, man. And, so let's get started from the top. I mean, just help people understand a little bit past your bio. Who are you and how'd you get to where you are today?
Yeah, I mean, I was really fortunate. My dad was an attorney, as was I, but all he did was real estate. So from the time I was 2 years old, I've literally been walking houses for 50 years. I'm 54 and I was walking them at 1 year old. And I owned a lot of properties in trust because my dad was kind of a tax ninja because his first job was with the IRS. So he had a lot of different weird partnerships and child partnerships. And, from the time I was, 5, 6, I remember going to rental properties, picking up the rent, meeting the tenants, talking to commercial tenants, kind of understanding what landlord-tenant relationships are. So, on that end, I was really fortunate to be like all access all the time. And, when I look back on it now, I think it was the greatest. But my dad was just a cool guy and he only had me on the weekends. So, part of it was just looking at real estate. And we would continually just pull the car over. I'm like, what are you doing? Like, we're going to get like McDonald's. Can you just relax? He's like, let me just go knock on this door. And so I grew up with that guy. He was like the original. I honestly still, he passed away when I was 33. So I don't know how he knew how to do all this stuff, but everything that people are, training and doing guru courses on now, he was doing it all. And you can still do it the old school way. We didn't have the internet. We focused on courthouse steps auctions and knocking on doors and going to yard sales. So that's the way I got started. And then as I got older, I started to branch out on my own, but I was already landlording as a teenager. So it was kind of easy for me to move forward. And he was a house flipper too. So we were, we lived in a different house every couple of years. We'd be like so mad. And then he would explain, this is how much we made. And I understood, I was young, but when somebody tells you we did it because we can get this and now we can go get a different house and do it again, it made sense.
Well, I mean, that's an incredible experience. I think really unique
fun.
to have such an entrepreneurial father, right? And have that just as a, kind of as a guidepost and like a place to start and getting started so early. I mean, what do you think all of that just knowledge and kind of upbringing, I mean, how did that guide your decision making as you approached career, investing, I mean, just life?
Yeah, I mean, it's different because if you look at it now, I think everyone wants to title themselves as a real estate investor. But like old schoolers like me, we were all just investing in real estate. Didn't know, I wouldn't have called myself a real estate investor. I wouldn't have called my dad a real estate investor. I would have just called him an attorney. But he didn't try to make money as an attorney. He tried to make money in real estate. So I was always doing real estate. So I kind of grew up in a time where I never knew how many doors I had. I've never been a doors person. I don't even count. I don't know. It's more, it's less. It's sometimes very little because we sell and we move and we change stuff around. But my dad was an opportunist and I think he taught me to be an opportunist. But it's, when I became an adult, I had my own money because my mom had passed away and my grandma had passed away and my dad had let me play with stocks from the time I was 15. So I think kind of being open to the idea of money and real estate really helped me understand to not be scared of it. Now it's like there's so much online content. I didn't have any online content. I had my dad in the car telling me about money and telling me dirty jokes. So, growing up in that time is different than now. So I can't tell people, hey, you should only do it old school. But you can still do it old school. And I had the benefit of, having that relationship and having fun and seeing real estate as something that you can do on the side. And it's just something that's a smart money thing. And I think it helped me just kind of not feel like I could have my hand in too many buckets. I just had a regular job and then I did real estate. And part of me growing up doing real estate was I was smart at buying my own houses, and I never passed on the enjoyment of owning real estate. I like it. I like to live in it. I like to have short-term rentals. I did for a long time. And these were all opportunity plays. And I think, some people now, they're too focused on the numbers and they forget that, your primary residence can be one of the best purchases you ever make, and you can scale appreciation depending on where you live. But, there's just so many different ways to make money. And I'm just glad my dad literally showed me all of them firsthand in person.
Yeah. I mean, I think that's an incredible experience to learn so early. It sounds like you really learned how to take action as well. Because I think a lot of people can get stuck in, like you said, this real estate investor. It's like such a big thing now, right? Where you're just like, oh, we were just doing that on the side because that's just what you did. Right. And it sounds like he just took a lot of action. He didn't sit behind the numbers. He didn't worry about all the courses and all the things. It's just like, just learn through repetition, and probably taught you how to just take action. Yeah.
I mean, I can boil it down, to when I was 15 or 14, my dad said, I'm going to give you X amount of money. It was a pretty decent amount for a kid. And he said, you're going to have this money, and this is your broker at Merrill Lynch. And I'm like, what do you mean? He's like, you're going to invest in stocks. You got to figure it out for yourself. You're going to talk to the broker. You tell him what to buy. He buys it. He'll give you some recommendations. They bought like easy things like Johnson & Johnson at the time, Gillette, like to set it up. And then I would read the stocks like box scores every single day. And I would start to look and understand, again, this is pre-internet. And I got nervous before I made my first trade, like told him to make the first trade on my own. I said, well, what happens if I lose it all? And he said, well, then you lose it all. You'll have learned a lesson. And I'm like, So to me, I never thought I was taking action. I was just always doing stuff. You know what I mean? Like now, I think we do look at it as like, because people believe that analysis paralysis is real. That's not real. It's just a lack of confidence. So like, I never knew that I was taking action. I just like to do stuff. You know what I mean?
Yeah.
And I'm not scared of risk, but I believe in educated risk. So when my dad would evaluate properties, he would tell me about all the pros and cons. And he said, like, the pros, they outweigh the cons. So let's take a risk. And I said, well, what if you find something later? He's like, well, we'll figure it out. And we hit some hobgoblins along the way. But, when you're buying foreclosures, at the time, sometimes people don't leave for 2-3 years. And we dealt with that. And my dad was a nice guy, so he would let them there. But you figure out the numbers. But I do think it's an interesting corollary, because the way that things are classified now, because there's so much social media and push to sell things, it's like, I just never even thought about it. I mean, lucky for me, but I think it's helped me continue that attitude to now, where walking away from a deal is of no consequence to me. And that's been one of my biggest leverage points over my whole career in any type of investing.
Yeah. And I had kind of similar to that, a great advice from a mentor. It's better to walk away from a bad deal, right? Yeah. You lose a lot less money that way. And there's always another deal. I think when people start, they get fixated on one deal, and you have all this sunk cost of time, but there's always another one. So
I think that's because of, one, emotional attachment, and two, because they don't have enough reps. If you're looking at houses all the time, like you lose. Like someone else has a better offer, especially now with all the multiple bids. Even in commercial, you're up against so many different people in groups who are well-heeled. Maybe they're not from your area. So I really think, like, for me, sometimes I've walked away from good deals, but as other people feel regret, I don't feel regret. Like, good for the person who got it. Looks like a good deal. Like, I kind of have this more universal attitude where, somebody's going to make a good deal. It's just not going to be me this time.
Yeah. Sounds like an abundance mindset is what people call that these days.
Yeah. Right. It's good for everybody. I mean, and I think of that when you're buying and selling and you're new and you're getting started, sometimes, you sell a property, you make, say, 50 grand, but then the next person you see sells in 2 years, they make 75 grand, and someone says, oh, you could have made 125. I'm like, well, I mean, I'm fine with my 50, and now I'm repurposing the money, and good job for them. They made money too. That's a win-win cycle. And I really think if you look at American real estate, generally, if you just sit around and hold it, each person's going to make money each time, barring, what they do with their loans.
That's right. That's right. Well, Jonathan, I think that's an awesome kind of summary of your life as an active real estate investor. And one thing I wanted to talk to you a little bit about here is more the passive side of how you've transitioned over the years, 30 years active, and you've started to do some passive investing now and just understand, I think first, kind of your thought process there and what is the value proposition you see of being a passive investor as well?
Time. I mean, the time back to myself, from being active and managing and being a landlord. Now I can let someone else do the work who does that all day. And the reality is before I had my podcast, I didn't really, I've, been investing since I was a kid. I didn't really know about syndications. And then when I started doing it and I had all these syndicators, I'm like, this sounds pretty awesome. But I did notice like, hey, you really need, the trust the jockey thing. I was like, you really do need to work on the operator. But as I started talking to operators, I was like, I already feel a sense of trust. So then I would go to the website, do the research, set up a call. And I think the hardest thing for me in going from active to passive was ego and control. And once I broke those, it felt so good to trust someone who all they do all day is multifamily. Mm-hmm. That's all they do. And instead of me trying to go get a sixplex in Chicago, I can just get into 52 units in Chicago and just like watch along and trust. And to me, again, it's another educated risk principle. I'm putting my trust that this isn't going to go awry. I've looked at, some of the important things on the deal, but I don't spend, hours looking over a deal sheet. I know what I'm looking for. I look through it and then I'm going to make a decision. So, and again, I only started investing in syndications at the end of 2023 and now I'm in 4, and that's amounts to about 500, limited partner units. And it's been interesting for me to watch because now I'm in markets that I wouldn't be in on my own because why do I want to get a one-off in these towns? And I can be a multifamily when I don't want to be a landlord. So it's really giving me access. And also I can watch the deliverables, watch how they scale. So if I ever want to be on the GP end, I have good experience with good operators teaching me along the way.
Yeah, you made a lot of good points there. I want to hit on a couple of them. One is I had a very similar experience of, before I started actively doing syndications and running our own deals, right? I passively invested with a lot of syndicators for the same thought process of I want to see how these guys do it. Yeah. I want to see how they're, what the materials are, how they're putting it together, how they're running the deals, and really get kind of an inside look. And so I do think that that's an often overlooked value.
Absolutely.
And depending on where you're trying to go in your career, with real estate or your investing is it really is a way to see the inside of how groups that have a ton of experience do things, right? And it's a great it can be a great education if you do it the right way.
Yeah. And honestly, what I found is, there's not that many investors in most of my syndication deals. So if I have a really smart question, I've built up the relationship, I can call one of the operators, somebody in charge, and say like, hey, I had a question about this because I want to learn. And I think you made a really good point. It is something that's really, really overlooked because I think too many people are just focused on yield right now because maybe they're busy, but you're not going to be busy forever. You could lose a job. So I just like learning. I'm like kind of a psycho. I've done like 35 of those master classes and people are like, why would you do an astronaut master class? You're not going to space. I'm like, yeah, but it's cool. And I feel that way about all assets of real estate. And, that's why, this from having your podcast. And you get off in an hour and you're like, oh man, land flipping sounds awesome. I can't stop myself. You talk to and you hear about what other people are doing. And it's almost hard to stay in your lane because there's so much cool stuff. That's where syndications come in. If you're interested in mobile home parks and you have no interest in wanting to actually be a part of it, you can really focus and just get in on the action on one. And like you said, review the particulars and learn a lot. And maybe one day you buy a small one after you've learned.
Yeah. And it sounds like a couple other things you hit on is just as a passive investor, as active, right? You are really tied to that asset from a time standpoint, but also from, it's really difficult to actively manage things that are in different markets than you are, right? And do it from far away. I've never understood how people could live in New York and have an asset in Phoenix or something like that and really like manage it to the level that you need to. But through passive investing, you've been able to get diversification from an asset class standpoint, right? Because you're focused a lot on single family. It's allowed you to get into multi, and then you even mentioned mobile homes or storage or whatever your flavor is. You can diversify across multiple asset classes, which I think helps protect, your wealth.
Absolutely.
Also diversify across geographies, you mentioned, right? The ability to go to the Midwest or the Southwest or the Southeast, and right. And again, you're diversifying, you're spreading your wealth. That's how you protect what you've got, right?
Absolutely. I mean, I've always been, again, going back to the stock story. I mean, I've been diversified my whole life in terms of money. I like stocks. I like bonds. I like any type of assets. I have a lot in index funds because I think of index funds similar to how I look at syndications. I put the money there so I don't touch it. But in index funds, I could get it out if I want. Syndications, I can't get it out. So I'm almost protecting against myself. It's like, hey, don't try to do 2 flips. Like, I want to take some of that money off my plate so I can't touch it. And I have to trust somebody else. And it helps me reduce that as I get older. And, it's an ego thing also. When you're younger, you think you can do everything and you want to be active in flips. And then I like the end product when I'm flipping. I just don't like even 1 second of the process. So I started building a buffer, getting a project manager. And, I would go from going once a week. Sometimes I go like once a month because I just like to see the progress. And I know if there's a disaster, someone will tell me, but they also know what not to tell me because it's not going to do anything. I'm going to get mad at everything. So it's just easier to stay out. But with passive, there's nothing for me to be mad about. Everything to me, at least in what I've been dealing with, is very transparent. I can see the monthly deliverables. I can see what the rent percentage is. I can see the upgrades in rent. And I haven't done any value add. Mine are all pretty much either turnkey or, modified kind of renovations, upgrades. Yeah. So, they're pretty easy and they pay right away, which is working for me.
Yeah. So one more question, and then I want to go into more about how you, help people that are wanting to get into passive investments. With all your experience, how do you go about selecting the right ones? But before we go there, last thing I just think is super unique with your experience of being active for so long is I talk to a lot of people that are on the fence, right? And they haven't done either active or passive, but I think, and this is where I started, it's because what and you're familiar with is like, oh, how do I get in real estate? I got to go buy a single family. That was all I knew when I started, right? So I talked to a lot of people that are like, well, I want to be in real estate. I think I'm going to go buy a duplex or a quad or something, right? So talk to the person for a second that's like on that fence and they got a full-time job, right? And they're doing real estate on the side, like you have successfully for a long time. So you have good perspective. It's doable. But the difference in going and buying that flip or that duplex yourself versus making a passive investment and kind of, which side of the fence now where you are, would you recommend people go?
I'm telling everyone to go passive first if they're a high income earner and they are limited on time. They have enough time to do the due diligence, but people who are busy, they're like a doctor and they're like, I want to do a flip. I'm like, you're going to overtrust a contractor. You're going to lose your money once or twice. Like we all know what's coming. Listen to all the flippers on my show. Talk to me. We all know you're not going to do this well and it's going to take 2 times as long and cost 2.5 times as much. So wouldn't you rather just invest in something that you can check in with once a month? And do it. And sometimes they'll say like, oh, well, I don't have the time to do the due diligence. It's complicated. It's like, but you're going to buy a house and like see the basement once and think that you're okay when you've seen 7 houses in your whole life. So to me, I really think if you look at economy and the environment that we're in and high rates, I think that people who are high income earners are going to pass on buying houses. They're going to, what I call choice renters, rent really nice places, not sink their savings, and they're going to want to do something smart with their savings. And instead of going and managing a 4-plex, which will literally be your second job and then make you worse at your regular job, they're going to just go into multifamily like I am now and cruising around and enjoying it. And I do think you have to take a lot of time, as I know we're going to get to right after, in vetting the operator and the deal. But I just see that passive investing is just a smarter way to let your money work for you when you don't have to do any of the work. And for the people out there who think flipping is going to be easy or fun, or being a landlord is easy or fun, it's not. It's generally not. It's just,
it's not.
No, nobody wakes up every day and says, I love being a landlord. Landlords get calls on Thanksgiving to unclog a toilet. That's what being a landlord is. And I did it a million times. My dad, we would be eating dinner and my dad's like, I got to go. He's like, you're coming with me. I'm like, I don't want to go. He's like, come on, let's go. You got to learn about the bad parts of landlording too. And I think that's the perspective that's hard to find because everything on social media, just makes it look like everything's easy. You can see, hey, let's just in fact, buy a bunch of Section 8 rentals. Nothing wrong with Section 8 rentals. They could be really profitable, but you have to really understand what you're doing and the bureaucracy to be really good at it. And it's going to be a fail for most people.
Man, I think there's a lot of wisdom in that. So I hope you guys are listening to what Jonathan's saying, because it is. HGTV has ruined it for everybody, right? Everything. It's like, oh, you could flip this house in a day. And I don't know where they get their budgets from, but I've never seen
fake
costs.
Yeah, but if you're an avid looker like me, and of course I have a license, so I'm always looking at houses and showing clients, but half the flips are just absolute disasters. And you're like, what are these people thinking? They watch one show and they're just like, it's not even done. They've cut corners. It's just like the scale of good flippers and bad flippers is so wide. And it's because people are doing it without thinking of it like a business. Everything that you do with real estate, you should be looking at with a business lens, not an emotional lens. And, sure, you watch one, flip or flop, you're going to be the flop most likely.
Yeah, that's really such good wisdom there. The nugget of because I do feel like this is lost in people's perspective. Real estate, each of these houses or each of these apartments is a business in and of itself.
Absolutely.
Right? You've got your capital expenses, you've got your operating expenses, you've got to make revenue. And I think that gets lost. I think that perspective really gets lost. And that's this perspective I gained, I think even after a couple of years of doing it, of wow, these really are each their own individual business. And you have to approach it with that level of just sincerity, I think, as you approach it.
Yeah. And think about it now with 100% bonus depreciation being back, you need to understand that every asset is a business, like you're saying, because now you can use this depreciation even better to scale your taxes and to do it in different years. So you have so many more options when you look at it like that. And look, of course, your first one, it's going to be so much fun, but the reason that people don't get that perspective is because they don't know enough real estate investors. If you're doing it on your own and you don't know any investors, you're going to screw up because no one's going to tell you. Or if you just like an echo chamber of your family who says, yeah, you're doing great. You're doing great. Oh, wait, it costs how much? $19,000 for a bathroom. It should have been like $6,500. You have to know other real estate investors. And even with passive, as we're talking, meet other limited partners so they can tell you what works for them. You're getting that from me on this, but a lot of people have had bad experience, but you have to find out why before you just trash all syndications. A lot is user error of them not doing the research. And it's not always the syndicator that's the problem or the deal. Sometimes it was all laid out for them there and they were just not paying attention.
Yeah. And that's a perfect segue into the next thing I want to talk about, which is, great for setting me up. So as you've moved now into passive, we talked about the sponsor a lot and I firmly believe, even being a sponsor myself, but having invested with a lot of other sponsors, you have to really, it is about the jockey, kind of like you said, right? And it's about that team. So as you're looking at choosing passive investments, walk us through that process. What are you looking at first, second, third, and how do you evaluate some of those key areas?
Yeah, first is really operator. I learned a lot from Brian Burke's book, The Hands-Off Investor. It was really the first syndication kind of Bible that I was like, oh, wow, this is a lot. There's actually a lot to consider, but it really I need to have a strong trust value on the operator first. Even if I don't know them that well, I have to get that trust vibe and then I'll do my due diligence. And part of what I do when I'm looking at that is I see if someone's just, being straightforward or if they're boasting. Boasters don't work for me because I feel like it's, fluffing. And if you're good at your job, you don't fluff it. If I go to somebody to fix my car and they say it costs this much, and it's more than I expected, but like they know what they're doing. And like, that's just the price. I don't ask for a discount. I just pay it. I want someone who's straightforward and not trying to, play it into, hey, this carburetor is going to make you last, 30 years and then your car's going to be worth more. Now you're selling me a show. So that's kind of what I look for in the operator. Secondarily for me, looking at the debt right away. I'm so happy that I learned that before I dunked in 2023 into my first one, because I know lots of friends who did, and they were on adjustable rate or bridge loans, and it didn't work as well. And some are still doing okay. But I looked at the debt really hard, and all I looked for was fixed debt, 5 to 7 years. And look, those rates were good. And so all of mine are fixed debt, for 5 years, because I figure, okay, I'll be okay because their fixed rate debt is good. Yeah, if we hit the 5-year cycle and rates haven't come down, could some places be in trouble? Some, not mine, because I think the financials are good. But that's an issue though for some who 2021 were at 3%, and it's actually generating okay, but now they're at their 5-year bust and they have to refinance, and now it's going to be 7, and there's not enough stuff in the middle to take care of that. So it's operator, debt, and then I obviously look at the pro forma. I look at everything out there. I look at the asset really closely. I look at the year built as really, really important to me. 3 of my 4 syndication investments are 2020 builds or more. And that's been really important. I feel like I'm lowering the risk a lot there. I maybe reduced my overall out value, but I'm reducing the risk greatly. One's like a 70s. So I was going for more of a little bit more of an upgrade there. But those are really the 3 keys to me, including the pro forma. But I don't obsess over what the 10-year and 20-year projections, because we don't know what's going to happen. So it's not really for me to see what I'm going to get in the end. I'm just looking at, is this asset going to turn money right away? Is the process that they're using, whether it be tenant turnover, rent upgrades, or kind of mini renovation, is that work with, how it's going to work for me? Yeah. And then I immediately at the end, I'm going right back to the jockey again and saying, like, having that last conversation, do I really get a feeling like they're being realistic? And I think part of that is always, what was the worst deal? I think that's a great question to ask a syndicator, because if they haven't had a worse deal, you don't want to be the first one.
You always learn from the losses more than the wins, right? Yeah. And so, as you've done this, as anyone that's done this long enough, right? I always look at real estate investing as you're really solving problems every day. Right?
Absolutely.
And if you can solve problems and you can effectively complete the business plan, then you can be successful. But you can't go into it thinking there's going to be no problems.
No, and I don't think you should want to win all the time. Like, when somebody says, like, do you ever gamble? Like, just random, but it'll make sense in the end. I'm like, well, I don't. If I go to Las Vegas, which I hate, if I'm going in a place where I gamble, I just consider it entertainment money. I'm like, I'm going to take out $300 and I know I'm going to lose it. So I'm not like in this mindset where like I'm going to win $1 million. Like, I'm just getting the entertainment out of it. And sometimes with real estate, you're going to get a learning lesson out of it. Some people are so scared to sell a property because they're like, oh, I'm only going to break even. It's like, but then you get the down payment back and you can repurpose it into something that's going to have a more scalable, trajectory, instead of just sitting on an asset that you don't like. And just a side note, I think that's one of the things that I think people who invested too quickly, the biggest mistake they're making now is they're not combing their portfolio all the time. They have maybe 10, 14 units of their own. Probably like 4 of them suck, but they're just like, they're just trying to get more. And it's like, well, if you just got rid of these assets, even if you get rid of them at a loss, you get back the money, you probably still have appreciation. So you're not going to like lose a ton, and just repurposing it. Why do you want to hold an asset that's not good? Hoping that it's going to like validate your decision later. It's probably not going to happen if it hasn't happened in 5 years.
Yeah. Well, I think that's a really great way to think about it too. You've always got to be evaluating, is this the best place for me to have my money, or can I, take a little, maybe not even taking a loss, maybe you're just breaking even, right?
Right.
The nice thing about real estate is, as long as you mentioned the debt, which I love, I don't think people focus enough on debt. Yeah. Debt is typically 60, 70% of the capital, right? So it makes a big thing. As long as the debt is right, it's difficult to really lose money in these deals that we do, because you're building a lot of cushion in. You really, the only way you could really do it is go wrong on the debt.
Yeah.
Other ways, you might not get what you thought, But even if you're breaking even, you could redeploy into something, as you said, with the verbiage you used, it was good. It's kind of a scalable upside.
Yeah, scalable trajectory. I don't know.
There you
Trajectory always works for me because it looks like, this line that you would see like in some thing, and it makes it's always going up to me.
But I think that's a good way to think about it, as like a basket of investments, and you're always trying to, even if everyone can't be a winner, as you said, over time, they won't all be, but collectively, right, everything is on an upward trajectory, and you're constantly looking, at the winners and the losers and evaluating what's going on. Yeah, really smart. I think, again, a ton of wisdom. I think as one thing that you mentioned, I'm curious, you talked a lot about the sponsor. I'm curious, as you look at the sponsor, obviously there's the individuals that are kind of on the webinars and their faces around the thing. But how much do you dig in to like the team behind them and kind of the group and the management and all of that and kind of look at it collectively? I'm curious how you're evaluating kind of the team that's really running the show.
Yeah, I look at the duration of employment for who's behind the scenes and see how long they've been active, and where they knew each other from. That's important to me. You can, like LinkedIn's the greatest resource for anything. You can just look back at the scale and see where people work together. I don't go too deep. I'm not going, 8 rungs down to the male intern, but I'm definitely looking around to see who else am I going to talk to. That's usually what I say, because of course, like a lot of them, you're going to have your upfront, head of marketing person. Sometimes it's the GP, sometimes it's part of the group, but I just want to know, who else am I ever going to talk to? Because I don't want to talk to a lot of people. That's one of my pet peeves is, I don't want to call in as somebody who has a decent amount of money into a deal and like talk to a VA because I can't get the money out. So I'll just be frustrated a lot. So I just want to know who, just like, when you're dealing with home buyers, you want to know, are all the decision makers here? I want to know who are going to be the decision makers and who am I going to be in touch with? And those are really the people that I'm most concerned about, because I can't control anything. And part of being in a syndication is giving up that control. So I just focus on the people generally who I'll be in touch with, and the rest I'm going to trust that they've built a good team. And I do look through their bios though.
Yeah, no, it makes sense. So recapping, really starts with the sponsors, right? And then looking at the debt, which I think is super smart. Understanding the debt, fixed, variable, right? Interest only, how long, right? Because like you mentioned, one of the ways that you can really get jammed up in real estate is having a debt mature. Yeah. At a time that's not advantageous, right? That forces you to make a move. Yeah. It forces you to refi, to sell. And it might be at a time in the market. So having debt that with a term that really aligns with the hold period, right? I think you think about, those bridge loans where you got a 5-year hold, but 2-year term. And that can be difficult. And, that was kind of the in vogue thing back then, And so I think now I think people have learned a lot from debt. I think looking at fixed debt is very smart, way to evaluate. And then you mentioned the business plan, right? And you've got that wealth of experience and everything you've done to kind of evaluate. But what you've said I thought was good was, is it realistic? Right? Yeah. So what you're looking at when you say, is it realistic, is really you're looking at the assumptions they're making, right? Which I think is what's so important for people to understand and really ask, okay, what assumptions are they making to get me the return that they say they're going to get me, right? Because at the end of the day, that's really, I think what drives a lot of, like when I think about a risk adjusted return, I think about it as, what's the likelihood I actually get that return? Yeah. Yeah. Right. And a lot of that comes down to the assumptions that people are making to get there.
Yeah, in particular for me, that's why my 3 of them are 2020 builds and above. It's not a rehab. So it's really like it's already producing, but they have good relationships. So they're taking it over from somebody else at a good deal, win-win, like we talked about before. But yeah, I am interested in other ones where there's a little bit more risk, like hotel conversions is interesting to me because I just feel like, that could be really, could be cool down the line. But I think now with 4, I'm kind of like, I'm good now. And now it's funny because this is kind of like full cycle to our conversation. Now I'm looking for short-term rentals again, not because I really want to get a second job, but because I again, with the podcast, I've had like the best in the game on short-term rentals on. So now I feel like, oh, my game is really up. And I used to do them, 25 years ago with my sister. Mm-hmm. So I have good experience with it. And I'm like, now I think I can handle one and one in that with the bonus depreciation and STR things. I'm like, so I'm kind of if I look at my overall portfolio, I scaled it way, way down to like almost nothing, and then I started going back up with syndications, and now I'm looking for other assets that I think are mildly active, something that I can, have fun with and still have, still use. Short-term rentals to me are always usable. Like I would never get one that I'm not going to use, maybe later, but now there's no point. If it's so cool, I want to go there.
Yeah, absolutely.
I don't want everyone else to enjoy it and not me.
Well, you're just continuing to diversify, right? And the passive piece has become kind of another tool in the tool belt.
Yeah, and it feels really safe. It's really like, I think my kids are 23 and 21 now, and it's like my dad did a different job. People always ask me, hey, did you do with your kids what your dad did with you? I'm like, no, they had phones. Like I couldn't capture their attention. I had nothing to do when in the car. There was literally nothing to do other than listen to music. So it's like I had to talk to my dad. My kids grew up in a different era, so I don't hold it against them that they don't want to talk about money with me while we're driving when they have an iPad. That's my fault, So you have to understand that it's a different way of teaching your kids. But what I found is that, as I was pretty interested as a teenager, but after my mom passed away at 20, I became even closer with my dad. I was close with both my parents, but like I really started to like get it in my early 20s, and both of my kids now in their early 20s much more interested in real estate, seeing how it works. They've always seen the flips, but now I'm even explaining to them about the passive investments. I show them on a chart, this is, what your legacy is going to be. We're going to try to roll this snowball big for you. And I think, I don't want to overburden them with too much knowledge, but I want them to get their head in the game. I had no choice. My dad was like, that's just all he talked about.
Yeah. Well, I mean, even though it's a different flavor, right? You're still exposing your kids just through your actions and what you're doing through this world that a lot of us just never got exposed to until, me in my 30s kind of dug in, And so I just think that's such a valuable lesson for your kids and showing them how to really build wealth, right? Which is something that is difficult to learn if you don't have a role model.
Yeah. And just think about it before I know we're going to get to your end questions, but I mean, if you just look at wealth and education, like there's nothing, going through with my kids going through middle, elementary, high school, junior high, all this stuff, they didn't learn anything about money. Like standardized education doesn't teach you anything about life in general. Like they've taken all the cool stuff out. There's no more like home ec is out, drama's out, like all the stuff that really are your passions. And they're just making you like, obviously some of the stuff's relevant, but like, I'm not doing trigonometry right now. Not that someone can't benefit from it, but it's just like, there's so much more money learning that could help people, especially when we're going into this like AI world now where a lot of jobs are going to be swept. And it's really about how you react to AI, how you use it, and how you can find things that aren't going to be taken over, or how you can be kind of an asset with it. That I think if kids knew more about money, there's a lot of people who figured out side hustles, but a lot of the side hustles out there, they're very short-minded. Just like in real estate investing, people are looking for quick fixes because all this guru stuff out there, instead of thinking like, hey, look, everything's a long-term investment. And again, I was super fortunate that my dad always put long-term in, you just buy weird properties and like just hold it. And I still have a piece of land that I'm about to try to develop in New York that I've owned for like, 30 years, just some weird land that he bought near Woodstock. And it's like, this is cool. I'm going to do cool stuff like that for my kids. Yeah. Maybe they don't know what to do with it, but I'm thinking like, I want to build, like 4 short-term rentals or at least a house for myself as a worst case scenario. So
no, I love that. I think just a great, like I said, great role model and teaching your kids early about how to build wealth. And well, Jonathan, as we round out the show, I'm going to take you through our keys to success round.
I'm ready.
Four questions to ask you. Should be easy for you. First question is putting your passive investor hat on, right? And you're looking at a deal. You don't know anything about it. You can only ask the sponsor one question. What's the one question you'd ask that sponsor?
Yeah, I'd ask what's the debt, because I like you were saying before, I think it goes kind of like underknown because, there's so many lines, there's so many pages of PDF, to look through that the debt is just one small line, whatever it is, 5.4%, 30 years. It's just in the middle. To me, that's the one question that I would ask right away. And, is it fixed or is it, variable of some kind?
Yeah, you really can understand a lot about the risk in the deal by just that one question.
If they don't just tell you a number and the years and they start explaining, you're in trouble.
Yeah.
That's why it's a good
If
question.
you're over explaining.
Let me just tell you about this variable rate. It's like, no, I'm good. I'm out.
What are you most proud of in your career?
I think what we just talked about, I think not forcing it on my kids, but bringing them to the table as they were ready. And honestly, following in my dad's footsteps and building this, legacy of all the stuff that he taught me that he couldn't see me complete. Like it's like when my dad passed away, I was still an attorney, and it was like he loved watching me be an attorney. He would come watch me in trials, coolest thing ever. But like after he passed away, I was like, I'm good. I don't need to do this anymore. But I was always doing real estate. But to think that he could somehow see me now, with the podcast and all the stuff that I do and meeting all these people like you and all these investors that I've met over the years, I think he would be really proud. So, I mean, the podcast and, what I do in real estate investing is really just an homage to him. So I'm pretty proud of that.
That's very cool. Very cool. What is a book that everybody should read?
Oh, yeah, I have a good one. Wait, it's called The Wealthy Gardener. Yeah, I almost lost it. Have you ever heard of it? It's underknown. It's by John Saforic. It's so good. It's kind of like it's half investing. It has a decent amount of gardening and a lot about money. It's a phenomenal book that not enough people know about. My real estate attorney recommended it to me, and it's one of my favorite books. It's just a really mindful read. And I think a kid could read it too. It's long, but it's definitely like no age range, and it's a story. So it's not like like Traction or something where you're like reading a book and you're like, just implement all these things. Like you're reading a story and getting the messages. So I think it can really sink in for a lot of people.
Cool. Tell me what the title is again.
The Wealthy Gardener by John Saforic. Gardener. Yeah.
Awesome. We'll make sure that's linked below.
So it's awesome.
Check it out. And then last question for you. What is your number one key to success?
I'd say mindset. I think I've grown into this kind of mindful nature over the years. I grew up a pretty rigid kid, and I've really moved away from that. And I think like mindset for me is making sure that I'm always good and centered. And, meditation, reading, all of these things have played a role. I read a lot. Like I think we're recording this in July. I've already read like 38 books this year. But like I said, I like to learn. So that all goes into the mindset. And with a lot of the stuff that we've talked about across the episode, my mindset helps me not freak out when stuff goes wrong in real estate or in life. I'm very steady. I'm always going to be steady for my kids. I'm going to be steady for my friends, and nothing really phases me. And part of that I learned as an attorney. I was a trial attorney. I was prosecutor for 8 years and criminal defense for 2 years. So like stuff happens crazy every single day. Witness can be on the stand, say something like complete opposite that you're expecting, and you just have to figure it out. So I think all of my experiences, including, where we started, the conversation with the dad who's just kind of like open to letting me do stuff, has allowed me to, over time, I'm 54, create a mindset that makes life a lot easier for me than it is for other people. And not because I've earned X amount. It's because I've loosened the reins on myself to be able to, take everything in stride and know that losing one deal is not the big thing. If something bad happens, probably something good's going to happen later. You just have no option but to kind of roll with the punches and keep a better attitude. That's really what helped me. And I think it continues to help me be successful.
Yeah, that's awesome. I think that's just a great perspective and good advice. And you're talking about meditation and reading and all these things that are going to keep you neutral, right? Not too high, not too low.
Yeah, exactly.
Well, yeah, but really good. Jonathan, thank you for sharing your wisdom about investing, getting into passive investing, and all the things that you've done. If folks want to learn more about you, they want to learn more about your podcast, how can they get a hold of you?
Yep. Podcast is called Zen and the Art of Real Estate Investing. You'll see Kent's episode somewhere like towards the end of August to the beginning of September. So we'll be in a race to see which one. And the website's the same as the name, Zen and the Art of Real Estate Investing.com. And if people are local to New Jersey, there's an events tab there. We do run meetups once a month. We just had one yesterday. And those are great for real estate investors to connect. My hub site is Trust Green with an E at the end. And that's my, label on Instagram. And, I'm pretty easy to find. I'm old, but I do all right on social. in what I consider to be the right way. You know, we've talked about all these investing gurus and stuff and mindfulness, but I just post whatever I want, whenever I want. I really have no rhyme or reason, no ghost writers, you know. And, you know, you find me on LinkedIn. I love LinkedIn. I think it's where the business people are at. So for people who are like, want to be real estate investors or are real estate investors or, you know, want to be where the business people are on LinkedIn, they're not on Facebook. I mean, they may be on Facebook also, but like LinkedIn, although it's becoming a little bit more, you know, unacceptable to me, I still find a huge amount of value from LinkedIn over the other ones. Instagram's fun. LinkedIn is like, oh crap, I'm gonna learn some stuff this morning.
Yeah. Well, awesome. Well, we'll make sure all that's linked below. Make sure people can find you and you know, listen to the podcast. The podcast is great, not just because I was on it, but because it's always very informational. I'm a regular listener now. So appreciate you coming on the show, Jonathan. I hope you have a great rest of the day.
Thanks so much, Kent. Really appreciate it. I enjoyed it.